All right, quick favor before we start. Hit subscribe if you want real-time market breakdowns like this, because something big just happened and most people are still looking at the wrong chart. In the last 24 hours, paper silver didn't just dip, it imploded. We're talking about a straight line drop from roughly $120 an ounce down to about $97. That's a minus 21.5% move in a single day. Roughly $1.4 trillion in paper value, gone. And here's the thesis I want you to sit with. This wasn't a collapse in demand, it was a leverage event. Both futures positioning data and physical premiums out of Asia confirmed it almost simultaneously, and that's why this matters right now. Stay with me, because I'm going to show you how to recognize this pattern the next time it happens before the headlines catch up. Before I explain what caused this, let me teach you something most people never learn about silver markets. When you hear silver price, you're usually looking at paper silver, not metal changing hands. Think of it like airline seats being traded back and forth without anyone actually boarding the plane. Most people don't understand that paper silver can trade at multiples of available physical supply, especially during parabolic moves. So when leverage builds, price looks strong, confidence looks strong, and everyone feels smart. But that strength is fragile. It's like stacking dominoes higher and higher. It works until one gust of wind hits. And when it does, price doesn't drift. It gaps. That's the mechanic you need to understand if you're going to survive these markets. Now, if this is making sense so far, drop a comment below and let me know where you're watching from, because I want to know how global this audience really is. Here's what you need to understand about leverage in commodity markets. When traders use margin, they're borrowing money to control positions much larger than their actual capital. Let's say you've got $10,000. With margin, you might control $100,000 worth of silver. That's great when price moves in your favor. Every dollar silver rises, you're making 10 times what you would have made with cash. But here's the thing. It cuts both ways. When price moves against you, losses multiply just as fast. And there's a threshold. When your account equity drops below the maintenance margin requirement, your broker doesn't call you for a friendly chat. They liquidate your position, immediately, no questions asked. Now here's what's actually happening. Let me break down the sequence in plain English. Silver ran hard, really hard. A near vertical rally pulled in leveraged futures traders chasing momentum. As price climbed, margin requirements became the silent risk. When silver stalled and ticked lower, margins got hit. Liquidity thinned fast, so when the first wave of forced selling hit, there weren't enough bids underneath. That's when cascades start. One margin call forces selling. That selling pushes price lower, which triggers the next margin call. And it feeds on itself. This isn't theory. This is mechanical. Once it starts, it doesn't care about fundamentals or sentiment or anything except math. Now let me layer in the second piece, because this is where it gets interesting. While COMEX paper prices were collapsing, physical silver in Shanghai stayed elevated. Premiums didn't crash, they held. That's your confirmation. Paper deleveraging on one side, physical tightness on the other. When you see that divergence, you're not looking at a demand problem. You're looking at a positioning problem. Physical buyers in Asia weren't panicking. They weren't dumping metal. They were actually holding firm, some of them even buying. Meanwhile, over on the futures side, algorithms and margin clerks were systematically unwinding positions without any regard for value. But here's the part that should make you nervous or excited, depending on how you're positioned. When those two diverge this sharply, it usually means the selling is mechanical, not emotional. And mechanical selling ends when the last forced seller is out. Think about what that means. Emotional sellers can capitulate slowly. They hesitate. They hope. They average down. Mechanical sellers don't have that luxury. They're done when the system says they're done. So the move might feel violent, but it's also finite. That's the paradox. The faster it happens, the cleaner the flush, and the sooner equilibrium can reset. Here's what very few people are talking about right now. The open interest on silver futures dropped by nearly 18% in a single session. That's not normal profit taking. That's forced liquidation. And historically, when open interest collapses that fast, it's a sign that speculative excess is being purged from the system. Now, does that mean the bottom is in? No, I'm not saying that. But it does mean the nature of the selling has shifted. You're not fighting a fundamental deterioration. You're watching a technical reset. This is the exact same playbook we saw in 2008. Back then, silver was climbing steadily through the summer. By September, it hit around $21 an ounce. Then Lehman collapsed. Liquidity froze everywhere. And silver, despite being a so-called safe haven, got crushed. It dropped to under $9 in a matter of weeks. People thought the silver story was dead. They thought industrial demand was finished. But what happened next? Once the forced selling exhausted and credit markets stabilized, silver didn't just recover. It went on a multi-year run that took it above $48 by 2011. It showed up again in 2011. After hitting that $48 peak, silver corrected hard. By late September, it had dropped back to the low 30s. Margin hikes from the CME added fuel to the fire. Every time they raised margin requirements, more leveraged traders got flushed out. The move looked catastrophic. But by early 2012, silver stabilized and spent years building a base. Same pattern. Leverage purge, followed by stabilization, followed by a longer-term repricing. And it repeated in March of 2020. Remember that? COVID hit, markets went haywire, and silver dropped from $18 to under $12 in about 2 weeks. Gold was supposed to be the ultimate safe haven, and even it sold off initially. Why? Because when liquidity dries up, everything becomes a source of funds. Traders sell what they can, not what they want. But once that flush ended and central banks flooded the system with stimulus, silver went from $12 to $30 in less than 6 months. Every time, silver experienced a violent paper flush that convinced everyone the story was over. Zoom out, and you see what followed. In each case, once leverage was purged and physical demand stayed intact, price didn't just recover, it repriced higher. The larger story is this: silver doesn't die quietly, it moves in shocks. And shocks usually come from positioning, not fundamentals. Now let me be skeptical for a moment, because you should be too. Could this mean something deeper is breaking? Could global demand be rolling over? Could we be entering a recession that kills industrial consumption? Let me be honest. If physical premiums were collapsing alongside futures, I'd be worried. If inventories were flooding the market and refiners were cutting production, I'd step back. And yes, manipulation narratives are everywhere right now. People love a villain. They love the idea that banks are conspiring to suppress prices. Maybe there's some truth to that. I don't know. Here's the thing about that. You don't need a villain to explain leverage math. Margin calls don't require conspiracy. They require volatility. Focus on what you can verify. Price action, positioning, physical signals. Those tell you what's real. Everything else is noise until proven otherwise. There are probably 3 types of people watching this right now. First, you might be long and feeling punched in the gut. Maybe you bought silver at $110 thinking it was going to $150. Maybe you're sitting on a position that's down 20% and you're wondering if you should cut losses or hold on. If that's you, breathe. Your job isn't to predict bottoms. It's to survive volatility. Know your exposure. Know your risk tolerance. If you're levered, understand that more pain might be coming. If you're holding physical, you've got time. Don't let a paper market flush shake you out of a position you bought for fundamental reasons. The worst thing you can do right now is make emotional decisions based on short-term price action. Second, you might be on the sidelines, thinking you dodged a bullet. You watched silver run from $80 to $120 and thought it was getting frothy. You stayed out. Now you're watching it crash and you're feeling vindicated. That's fair. For you, this is about patience. Forced selling creates opportunity, but only after it exhausts. Don't try to catch the falling knife. Wait for signs of stabilization. Wait for open interest to stop dropping. Wait for physical premiums to confirm that the paper market is finding a floor. Then you can start thinking about entry points. Third, you might be new, trying to understand why silver feels insane. You heard about the rally, you saw the crash, and you're wondering if this market is even worth participating in. Welcome to the metal. Silver is volatile. It always has been. It's smaller than gold, more industrial than gold, and way more sensitive to leverage. If you can't handle 20% moves in a day, this might not be your market. But if you're willing to learn the mechanics, if you're willing to think in terms of cycles instead of days, there's opportunity here. The universal principle for all of you is the same. Don't confuse volatility with invalidation. They're not the same thing. A 20% drop doesn't mean the thesis is broken. It means positioning got ahead of itself. So here's what I want you to answer in the comments. Where are you in this? Are you holding? Are you watching? Are you buying the dip? I want to hear real perspectives, not just cheerleading. So here's where I stand. I'm not panicking. I'm not euphoric. I'm watching. First, I'm watching the $95 to $100 zone. Historically, that's where stabilization usually starts if this is truly a flush. If price can hold above that range for a few sessions and start building some consolidation, that would tell me the forced selling is done. Second, I'm watching Shanghai premiums. Sustained levels above 20% historically matter. If those premiums stay elevated while COMEX stabilizes, that's your divergent signal telling you physical demand is still intact. Third, I'm watching futures open interest. When it stops falling, the purge is likely done. Once speculators are flushed and open interest flattens, that's when you start looking for the next leg. The way I see it, this move was mechanical, not fundamental. The fundamentals didn't break. Global silver demand is still strong. Industrial applications aren't disappearing. Solar panel production is still expanding. Electronics consumption is still growing. Central banks are still debating monetary policy in ways that historically favor hard assets. None of that changed in the last 24 hours. What changed was the amount of leverage in the system. And when leverage unwinds this fast, it creates distortions. Those distortions don't last forever. If history rhymes and silver stabilizes in the coming days, the move that follows could be significant. I'm not making a prediction. I'm saying the setup could be there, but you've got to let the process play out. You've got to let the selling exhaust. You've got to see confirmation from multiple signals, not just hope. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Don't take my word for it. But if you made it this far, you're someone who thinks critically. That mentality will serve you well in markets like this. If you found value in this breakdown, share it with someone who needs to hear it. Hit subscribe if you want more analysis like this when it matters, and stay sharp out there. Think critically, verify the data, and always make your own decisions.